Hi everyone and welcome to today's More Report on Tuesday the 18th of October with me, Richard Perry, Market Analyst at Hantec Markets. We've had a fairly sort of slight dollar correction overnight, and that has come basically with the comments from Stanley Fischer really that suggested that they were fairly mixed actually yesterday, sort of suggesting that low rates could sort of threaten economic stability, but also was saying that there was a little bit of an issue that the Fed could still face with raising rates. So the market took that as a little bit of a dollar negative move. And we've seen a slight dip overnight and again today. Not too significant. You've seen the sort of Treasury yields just dropping away slightly as well with that. But that's sort of generally helped to improve market sentiment really, because you've seen commodity prices being supported by that. You've seen the oil price, which had been under a little bit of pressure yesterday, bouncing, and again today it's around about sort of 0.5 to 0.75% higher today. Generally speaking, markets have been taken on a sort of fairly positive view today. That's increasingly positive actually. If you look on the on how the numbers are looking today, we've got European markets up around about 1% or so, looking pretty strong. And that's coming despite the fact that the S&P 500 was actually down yesterday. Nikkei was mildly high yesterday, but obviously the mood is improving as we go through. Now this dollar correction is certainly manifesting itself in a rally for sterling. Sterling's rallied quite strongly today, and actually I'll show you in the charts that it's broken a key near-term downtrend, which might suggest that it's beginning to settle. Although today we have the big inflation data. Inflation data for both the UK and US all out today. We're going to get a really strong indication of how Brexit is going to be impacting the UK inflation. Inflation is expected to tick higher to 0.9% from 0.6%, but look at this. Sorry, this is the chart. To 0.9% is the expectation, but the key factor is on the core data to 1.4, but the key factor is this producer prices index. The input prices are expected to again remain pretty high, 7.4%, so they were the highest since 2011 last month, and that suggests that producers are beginning to really feel the burn in terms of their cost prices increase. So that is a really important number that could well start to feed through into inflation in the coming months, and it will be certainly a number that the market will be looking out for. This afternoon we've also got US inflation. US inflation at 130, expected to be improved to plus 1.5% on the headline, and stay at 2.3% interestingly on the core. So 1.5% on the headline would be the highest since October 2014, and on the core stay at 2.3%. But yeah, it'll be interesting to see if we start to get traction on that, because if you see the core above 2.3%, that would be the highest since 2008. Anyway, so you've also got the NAHB housing market index, depending on where you get your indicators from. 653 is the expectation there. So sorry, let me just I've lost my numbers. Sorry, 63, that's the wrong number. I thought that was wrong. Anyway, so today that's how we're looking and how we're set up. So please join me again for my FX Trade of the Year competition data and the instruments that we're trading. So I wish you good luck.